It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me, the man of the hour, Mr. Michael Becker.
Hey, Paul. How's it going?
It's going great, Michael. It is the first couple days, weeks of the new decade, and I am excited about what's going on coming up in the next decade or so. I mean, I think there's truly optimism still in the marketplace, and so I think we'll talk a little bit about that. But did you have a good holiday?
Yeah, we traveled a bunch this year, so over the holidays we kind of stayed local, so it was kind of nice actually being home for a change. How about you? How was your holiday entail?
Very quiet, very low-key, so had a good time with family and friends, and so it was a lot of fun. So again, we appreciate everybody listening this last year. Again, we are trying to get 1,000 likes on iTunes. And so if you do have a second and you think we bring value to the conversation about multifamily, go into iTunes and give us a 5-star rating or a thumbs up on that. We would definitely appreciate that. That helps us bring you higher quality contents with more listeners listening to this podcast. Again, we're updating our 2020 17-page white paper report on kind of the state of trying to get into an apartment loan. So we've written, Michael has helped. So it was James Zhang, kind of a report about, we call it the white paper multifamily 101, about trying to get you into apartments by kind of knowing what the rule books are or what the checklist is. On the lender side, I mean, we bring 70-80% of the money to the table. So you want to get to know us really well. So you kind of want to have an insight of what we're looking for on that. Anything more to add to that?
No, yeah, I think that's good. Certainly you can find that at the oldcapitalpodcast.com website. So just go to oldcapitalpodcast.com and you guys can download the white paper as well as my sample due diligence checklist. It's kind of the checklist, the Christmas wish list coming out of the holidays of all the things that we want to get.
That's right.
We don't always get everything, but all the things we attempt to get when we're trying to do a thorough due diligence on a potential acquisition. So both those are at the oldcapitalpodcast.com. So speaking of that, I know we have a couple speaker events coming up. What does that look like for the winter and early spring?
Well, we certainly have one coming up here shortly. By the time you hear this, it should be up on January the 15th. We have Greg Willett coming into town. He's going to speak on kind of the state of the market 2020, and he's going to give us his presentation. I mean, Greg Willett, as you know, is a widely read economist that specializes in apartments on a national level. And so he's the guy everybody quotes as all the bankers listen to him. He's the guy that you want to come see. So on January 15th, come see us. It needs an RSVP to get in. We'll probably have 300 people there. We'd love to see you there. We're also going to have the CoStar economist that's going to specialize in North Texas. So it's going to be a great event because this is the presentation that Greg is going to give the 12,000 apartment investors that are going to come to National Multifamily Housing Council meeting in Orlando at the end of this month. And so he'll give you the updated information before the true 12,000 professional investors here. So we're blessed to have him come and present to us. And then we also have the Dr. Dotzer is going to be in the house in April. So Mark Dotzer from the Texas Real Estate Group, recently retired, but he is probably the most funny economist that we talk to. Great inside information, just a wealth of knowledge, and usually have 500 plus people that attend that event. And so that's a big one. So go on to oldcapitalpodcast.com and RSVP for our events. We appreciate that. So again, Ask Mike Mondays. We talk with Michael Becker. As you know, Michael is a former, I guess, like a former Marine. You're never an ex-Marine, but you're a former banker. So Michael was a banker for a large bank throughout the nation. He led his division for 6 years in a row. He's the guy that everyone listens to on the banking side, and then he made the transition from loaning money to being an owner of real estate. And then SPI, his group, has done over $1 billion. $1 billion. That's a B of purchased apartments. They've done 40 transactions. They've purchased over 8,600 units. They've done 23 deal cycles. What does that mean, Michael?
Yeah, I got full cycle on 23 deals. So as we record this, we just sold our 15th deal, and we've had, they started to make 8 deals that we've refinanced, returned some capital still on today. So quite a few.
And then over 6,000 apartment units under management. So you guys are just knocking the ball out of the park. So We asked Michael these questions because we view him as a serious player, where the rubber meets the road and where you will get a lot of information from an actual highly successful operator to help your business. So here's the question for starting off the new year. Michael, it's the beginning of the new decade. What are you seeing in the apartment market? Any concerns?
I mean, I think a quick little just recap of the last decade might be something to consider. I mean, kind of if you think about where we were 10 years ago, it was kind of the depths of the apartment recession. I mean, I know that the economic contraction, I think, started in 2007, and really kind of the worst of it was 08, 09 for the economy. But for local apartment operators, I think 2010 was probably the worst from an operational standpoint. I don't know if you concur with that or not, Paul, but
absolutely,
it was kind of the worst. All that took a little while for all that to kind of trickle down into occupancy and rental rates. And so that was kind of like the depths of it. And then kind of where we finished out was kind of maybe a peak kind of from a valley to a peak in the 10-year span from 2010 to finishing out 2019. So I think I've said this before. It was kind of that last decade really was kind of the golden age of apartment ownership. I can't imagine it's going to be much better going forward than what it's been this last decade. I mean, everything for all the major metrics from occupancy to rental rate growth to, the debt terms, just materially improved over that timeline. The cap rates certainly have compressed. So if you own apartments for any length of time in that last decade, I mean, you just absolutely made outsized returns. I think kind of the last year or two, I think the return expectations have kind of moderated a little bit as the cap rates have certainly compressed. It's going to be really hard to kind of replicate some of the 3-4 multiples in 2-3 years that we achieved and a lot of other people similar to us have achieved. Those are just kind of not typical. So I think kind of the general state of the market from what I can tell. I mean we focus on Texas and Dallas Fort Worth and Austin are really the two markets we focus on. So it's what I know best, and every metropolitan area is going to be a little different. But the Texas markets that we focus on, I think we're still pretty optimistic going forward, Paul. I think fundamentals are still pretty sound from the standpoint that we have a tremendous amount of population growth and job growth. I think I saw an article yesterday, I think 1.35 million people, the metropolitan area of Dallas-Fort Worth is 1.35 million people more to start 2020 than it was to start 2010. So, you think about that, that's like almost 1.4 million. That's like Oklahoma City, right? The entire metropolitan area of Oklahoma City was put on top of Dallas-Fort Worth in a 10-year period. And the projections for the next 10 years, by 2030, I think there's going to be over 9 million people will be approaching the size of the Chicagoland area. So, I mean, and then by 2035, I think we'll be, 2035, 2036, something like that, we'll be, approaching 10 million people in the metropolitan area. So with that kind of population growth, those people are following jobs. Every time you turn around, seemingly we're reading another article about this corporation or that corporation relocating. I think that's been a consistent theme and trend for many, many years. And the tax laws changes of a couple of years ago now, where they reduced the SALTs and state and local income tax deduction, certainly, and then the regulations that a lot of the state and local governments on the Northeast and the West Coast are kind of imposing upon the local areas, are just kind of continuing to fuel corporations move jobs out of California and New York and New Jersey to places like Florida and Texas and Arizona. So we're kind of certainly getting our fair share or unfair share of that job transfers and corporate reloads, which then you kind of help fuel the population. So I think the fundamentals are pretty strong. Kind of where I'm maybe a little cautious is probably kind of what I've been a broken record and maybe a little early on. I don't think I'm wrong. I just think it was a little early. I think some of these areas, Paul, that kind of historically have been a little bit more higher crime challenged areas. The cap rates are certainly super compressed. So I think people are just disregarding some of the basic fundamentals of real estate and hasn't had consequences yet to their pocketbooks. But at some point, I think that might kind of come back and rear its head. And then certainly in this next decade, I can imagine going another 10 years of that without some level of recession or economic contraction. So I think those areas are a little bit more susceptible. So I'm a little bit worried about that, Paul. And then some of these people that are, buying the third generation of value add deals that are having to pay a, pretty large premium because for the privilege of doing the value add. And then they're putting, 85%, 87% bridge loans on these deals and kind of really over leveraging these deals in my estimation. So any one little hiccup might come kind of punch their lights out. So I think the people that buy in the better located areas kind of stick to the fundamentals and put properly sized and leveraged type loans on these things should just be fine because the natural population is going to continue to drive the fundamentals of multifamily in Texas. So I think those are kind of if you stick to the basics, Paul, I think you're going to be fine. And I'm really optimistic about the next 10 years, especially in the Texas markets. But, those are kind of the things I see as potential weaknesses.
No, I definitely agree with that. And you brought up an interesting point because you're making the comparison for the last 10 years. And if you went back to even farther back in some of the cloudy and dark skies of, say, 2008 to 2011, you had to go take a look back at maybe 2003 to 2008. 2003, 2008, that's probably was the rise of the subprime financing for single family. And as apartment owners, and since I've done this for 35 years and I've kind of followed the trends, apartment owners were very much challenged with having tenants jump out of their buildings. And why was that? Because the apartment landlords were competing against the tenants moving into single-family homes because it was almost cheaper to buy yourself a brand new house than to pay first, last month lease payments. So when they moved in, they did it for 100% financing. Sometimes they found themselves maybe with a car in the garage because that was kind of the bonus to buy this house, to do it before the end of the quarter. And so there was a lot of wacky stuff going on. So landlords were challenged between 2003 to 2008. And then they became more challenged when that whole subprime thing kind of fell off and the people moved back to the apartments because they lost their homes, because they forgot that when you live in an apartment, you typically have somebody cut your grass, somebody clean your unit. When people move out, they forget about the maintenance person that fixes the garbage disposal, and they didn't know how to really run a household, and so they got collapsed. They moved back to the apartments, but then their jobs got collapsed because the economy 2008, 2011, they're starting to lose their jobs, and we saw a lot of people in Texas lose their jobs. The economy just wasn't, across the United States, you had California values fell by 41%. We didn't have that big of a decline in the single family side in Texas, but there were some challenges out there. I don't see those challenges because we're not doing subprime single family transactions anymore. We still are kind of the center of the universe of job creation, whether it's Phoenix or Kansas City or Florida or North Carolina or Atlanta. I mean, we're still seeing a lot of jobs come from the north down to the south, and I'm from the north, and I've come to the south. But those are some of the things that I've seen in the past. But Michael brought up a couple of things, and I'm gonna let him jump in here. But I've seen the primary and secondary market cap rates converge to the narrowest gap this cycle. So it's at probably about 23 basis points between having a property in a primary market to having a property in a secondary market. And that limits how much more prices can rise for properties in secondary markets relative to the income from the properties. Though the secondary markets continue to get more and more attention from the buyers. Another thing is, value-added investments are now more difficult as the yield for these investments become thinner. I see a lot of transactions come in. A lot of people are still trying to find the value add. There's just not a lot of value added out there. I mean, I think
that's what's driving the secondary market stuff, because they look around and every deal in Dallas has been valued at twice already. So you're on 3.0 value add on all the stuff in South Irving or Arlington or whatever.
What is it, Filene's basement, where everybody jumps to try to get the best deal that they can?
I mean, how many OMs have you seen that said, only 5% hard surface countertops, so now they're throwing in quartz and a 1984 product in, OK part of Arlington. I mean, that's kind of the new value add.
Yeah, so value add today is still difficult to compare to the earlier parts of the cycle back about 10 years ago or maybe 9 years ago. So investors are looking for newer, riskier kinds of apartment investments where they can earn the reward of a higher yield. Hell, I just saw on Facebook this morning an apartment investor that is now doing due diligence on a hotel that they want to buy. So they've taken it from doing apartments now to doing hotels. Yeah, I guess it kind of looks like that. Instead of having tenants for a month or 6 months signing leases, they sign a lease every day.
Or by the hour at some hotels, I guess, right? So depending on the hotel, I guess.
So the thirst for yield has also led to increasing interest rates and alternative multifamily, multi-housing concepts such as co-living and short-term rental business models. And these sectors are looking to expect to continue. So think of student housing. If you ever went to a large university and that you shared your place with, say, 4 other people and everyone got their own room, that's kind of what the future is in some of these high cost areas, whether it's New York or Chicago. This co-living is starting to become a larger part of the business, and there's new capital sources. I haven't done any of that type of business, but I'm starting to hear about alternative ways of getting stuff done. I'm very optimistic for 2020. I believe the multifamily sector is going to remain, a rich environment for high net worth investors and family offices. And so, if you are an investor still looking to get in, I still see that there's opportunity. The capital markets are open. The jobs are doing well. I mean, I don't know, especially don't know if there's going to be ever any impact for the election coming up here at the end, close to the end of the year. But I think the fundamentals are still in place and we're still looking good.
Yeah, I mean, I just think I guess my final comment really would be on the secondary market stuff. We own a few deals in a small market called Tyler. It's about 200,000 people, just 2 hours or less east of Dallas. One of our partners, and we didn't pay the same cap rate that we would pay in Dallas on this stuff. We had a pretty healthy discount, and we're buying in a market that had pretty high median income around us. So I think there's not necessarily anything wrong with the secondary markets, but Amarillo or Abilene is not Austin, right? Some of those the durability income and those types of markets are very, very different. The velocity of tenants moving in and out of those markets are very, very different, and the availability of the vendors and employees and everything is very, very different. So if you're going to go to Amarillo or Abilene, you better get paid by having a much materially higher cap rate relative like Austin or Dallas or one of the more kind of major primary markets, just because they're just not nearly as diverse and there's not as much velocity of people moving in that market. So you can't come in with your Dallas brand. I think you can go there and dump 5,000, 7,000 a unit and push rents $100 across the board because that pond isn't that deep.
Yeah, we've learned that in areas of like Oklahoma, New Mexico, some of these areas that maybe kind of sound like Texas, Southwest type of thing, but they're not.
Yeah, because the area median income of Oklahoma City's got to be 30%, 40% lower than Dallas, right? So just think about it. They just don't have the disposable income to pay these higher rents.
Yeah, the whole state of New Mexico, I think, has 1 million people in it. So versus
the city of Dallas has more people than the entire state of New Mexico, right?
Yeah, so it becomes sometimes a challenge to get into some of these areas without knowing the full story. So do your research into these areas. Yeah.
Not that they're bad. Just make sure that everything works at a price. Generally speaking, just make sure you're not getting a 50 bip higher cap rate and you take a materially higher amount of risk. So I think the concept of risk adjusted returns, the risk adjusted part of it, I think is getting out of whack as we get a little longer in this cycle, whether that's in the hood or whether that's in a small secondary market.
Well, I would think that would just make sense, whether it's like stocks. Right before any problems, you have to go out and take a look at other opportunities to try to get growth. And so if people want to get a little bit more information on what you guys do over at SPI, again, that stands for
SPI Advisory, which is Strategic Property Investment. It's kind of what the acronym stands for. So basically what we do, Paul, is what we're really focused on for 2020 is just try to put together a handful of pretty high quality apartment transactions where we buy and we go out and syndicate the equity. So if you guys are interested in learning a little bit more about what we do, the best way to find out more information about us, simply go to our company's website, which is www.spiadvisory.com. That's SPI like spy, advisory.com. There's a contact us form. Fill that out. I'm always happy to have a 10 to 15 minute call with listeners of the podcast. And, the goal this year, hopefully, Paul, is like 3 to 4 apartment syndications, hopefully about 1 a quarter. So we need to get to work because I don't have anything actively right now to go put out.
But you are very active because you have to put out 1,100 K1s.
Yeah, we're doing taxes right now. So between this time this thing airs and February 15th, hopefully we get about 1,100 or more K1s out this year.
That is a big job. So congratulations on another great year at SPI for 2019. Again, if you want to get any additional information, what's the best email address again?
Oh, yeah, just go to our website, which is spiadvisory.com, and there's a contact us form. Just fill that out.
All right, if you want to get any information concerning apartment financing, again, Old Capital is a national lender. So go into the oldcapitallending.com website, oldcapitallending.com, and then take a look and see if there's anything that we can do to help you finance apartments for 2020. Again, great information, Michael. We appreciate that. Again, I'm Paul Peebles. That was Michael Becker. Have a great day.